Stock Targets.
This is Sean Kelly at stocktargets.com.
I hope you're all doing well.
We're going to talk about a new way of calculating oil reserves. Oil companies have imposed on the investor community old and outdated oil reserve ratios. The frequently used reserves to production ratio is obsolete and means nothing, especially when a country has a declining oil production. The person using these ratios is a person intentionally misleading you. And the oil industry uses these ratios all the time.
Today we're going to get rid of some old stuff which burdens us in the world of oil. What burdens us are these old, outdated ratios given to us by the oil industry, which are very misleading, give us a good picture of the oil industry, when actually things are not doing well at all.
Take an example. Here's Mexico. In the 1970s, their oil production was 495,000 barrels per day, and the estimated reserves 34 billion barrels. The reserves to production ratio indicated that there were 188 and a half years of reserves left. This makes a great ratio, many years of production left, and this would have made a great investment decision in the 1970s. And here's the graphic example. In 1970, 188 years of oil reserves ahead of you. That would have been a great investment decision. Your investment would have benefited of a lot of volume increases and a lot of price increases. In 2003, the Mexican oil production was close to 3.5 million barrels per day, and the estimated reserves 12 billion barrels. The old reserves to production ratio indicated 9.5 years of reserves left. Therefore, the ratio being low, the investment decision should have been lousy. But meanwhile, the oil prices doubled and still made it a good investment decision. Here you can see it graphically. The production to reserves ratio has a very different meaning in an uptrending production scenario and in a downtrending production scenario. In 2012, Mexico's oil production dropped by 25% from 2003, bringing it to 2.592 million barrels per day, and the estimated reserves at 10.4 billion barrels. So the good old reserves to production ratio indicated that there were 10.5 years of reserves left, which is a better ratio than back in 2003, but a very poor investment decision. With a dropping production, that ratio isn't a good investment criteria at all, and always tends to embellish the situation. As said before, the people still using that criteria of reserves to production, indicated in years, are intentionally giving you misleading information. That is how poor this ratio is. So let's now go to the real way of calculating oil reserves.
Okay, first let's look at a traditional production bell-shaped curve.
Every resource extraction follows a bell-shaped curve. First you have a nice growth rate, then you come to a 0% growth rate, and then you go into negative growth, and finally you depleted completely that particular resource in that resource field. During the first half, which is the left-hand side of the chart, 50% of the resource is being extracted, which we can break down in two quarters, which is the first quarter about 16% and then 34%. Those are the definitions of the standard deviations. Then you hit a peak point where the growth rate of extraction is close to zero. At that peak point, here symbolized by the year 2000, which is just a theoretical graph, you discover that 50% of the resource has been extracted. That's the left-hand side of the graph, or the area under the left-hand side of the graph. And the right-hand side of the graph then also shows 50% of resources remaining to be extracted. Adding bell-shaped curves field by field gives you a bell-shaped curve for the country. And then adding bell-shaped curves of countries, country after country, gives you then a bell-shaped curve for planet Earth. Here is the example of Mexico, which speaks for itself. The advantage of Mexico is that we have a lot of accurate statistics, and we are well advanced in the knowledge of what we have in terms of reserves. So in Mexico we have 41.8 billion barrels of oil which have been pulled out of the ground since inception, and this until end 2012. In early 2013, official Mexican oil reserves are 10.4 billion barrels. Here you have a chart of the Mexican oil reserves, the way they looked, first in the 1980s and then in the 1990s. First we had around 50 billion in reserves, and then during the 2000s, when production was starting to decline, we actually discovered that we had much less as we were pumping it out. Today in 2013 we have 10.4 billion barrels left. Thus 80.1% of the Mexican oil is now gone. Only 19.9% of the Mexican oil is left, with no new discovery during the last 16 years. The area under the right-hand side of the curve after 2012 has to be 19.9% of the total area under the red curve. Thus, the Mexican oil production has to drop by at least 7% per year in order to remain coherent with the area under the curve after 2012.
So here's a new way of looking at oil reserves. It takes into consideration what has been extracted in the past by comparison to what is still left in the ground tomorrow.
And the new way of determining the oil reserve situation in a country is the following: the amount of oil already extracted since inception and the amount of oil left according to government or private sources. The total of these two amounts comes out to be the all-time reserves. The ratio of the already produced oil over the all-time reserves gives a percentage of emptiness of the country's oil reserves. In our Mexican example, we have at the end of 2012 41.75 billion barrels already extracted since 1960 and 10.4 billion barrels remaining. The ratio is thereby expressed as 41.75 divided by 41.75 plus 1040 equals 80.1%. 80.1% empty, that is the ratio we're looking at for Mexico today. And when we say empty, we talk about really empty. There are no new oil discoveries in sight in Mexico. Perhaps 20 years down the line when they're able to drill at 10,000 meters depth. That is what we're trying to say. The rate of emptiness of a country in terms of oil reserves is the relevant number to look at.
The percentage of emptiness is really what we're looking at. And today you really can see the difference between what has been pulled out and what is going to be pulled out in the future. And quite frankly, the situation is not looking good. Oil producing countries or oil exporting countries
starting
have
with
less and less oil.
These four countries, Saudi Arabia, Russian Federation, United Arab Emirates, and Kuwait, account for half of all net world oil exports. It is to be noticed in the first two yellow squares, Saudi Arabia and the Russian Federation today have pulled out of their grounds more oil than they have in reserves left. This is an indication of how the future will look in terms of exports. Here are the next players on the list. Iraq, Nigeria, Venezuela, Iran, Qatar all have good net exports per day. But all these five countries together are only the size of Saudi Arabia in terms of exports. The past production to reserves ratio is still interesting. We are below 50% for all of them, therefore we can expect some growth in production. The past production to reserves ratio is still interesting. We are below 50% for all of them, therefore we can expect some growth in production. Here are the followers. In there, intentionally, I have Canada as an oil exporter, but with very little oil reserves remaining. That is the conventional oil.
Now let's look at the
tar sands have
not
been
so
left
good
out
countries.
intentionally. Here is the next and last group of oil exporters. As you can see in the net exports per day, the quantities are not very large. Mexico is starting to drop real fast on that list. Again, everybody is in the red, therefore less oil available than has already been pulled out of the ground. Now let's have a look at the former oil export countries or big consumers. First, the USA, 234 billion barrels have been pulled out of the ground since 1859. Remaining oil reserves, 25.5 billion. That means the USA is 90% empty today. Here also a few interesting numbers. China, UK, Indonesia are all quite empty. India, not a big producer, not a lot of reserves, nevertheless a big consumer country. Then Brazil, a bit of a surprise. They still have some nice reserves offshore, but fairly deep, difficult to get to. Yet if we look at the ratio, it looks interesting. Therefore we have the number in a green box. So in conclusion, the reserves to production ratio is an outdated ratio, which has no meaning in a decreasing production environment. So when you are given that ratio, just say to yourself that it's propaganda. The past production to reserves ratio is much more meaningful, the way we show it in this video. If the ratio is well below 50%, it will give you the countries where volume increases and price increases can happen. And therefore, it will help you in your decisions on where to put your money when investing in oil. And just don't be fooled by a oil industry exec giving you that old ratio, which is the reserves to production ratio. It just doesn't mean anything anymore nowadays.
This is Sean Kelly at StockTargets.com.
Stock Targets.